What's up, Automation Nation? Andy here. Welcome to the first video in my new home studio. If you've ever been turned down for a loan or faced sky-high interest rates, don't worry, I'm here to demystify this process for you and give you the secret formula that I use and recommend to all my clients so that you can watch your credit score skyrocket effortlessly on autopilot. So stay tuned to the end for that. Before we jump into how to fix a credit score, we have to first understand what causes a bad credit score in the first place. Late payments. If you miss a payment on a loan or credit card, it can significantly impact your scores. As you can see, this makes up actually 35% of your overall scores. For example, if you have a credit card, even with a $1,000 limit, a late payment can drop your scores by 50 to 100 points, depending on how late the payment is. Maxed out cards. A card is considered maxed out if you're using all or almost all of the available credit. This can hurt you because how much you owe in total as a percentage affects like 30% of your overall score. So we call this the utilization rate. If you have 5,000 of available credit and you've got 4,000 on a card, that's an 80% utilization rate. And that card is getting real close to maxed out. Because if you're using a lot of credit, lenders can think that you might be in a financial pickle. A utilization rate above 30% can drop your score 30 to 50 points even. So if you have a total credit limit of 5,000, let's shoot to keep no more than 1,500 or 30% utilization rate on your card at any given time so that it doesn't negatively impact your scores. Now, filing for bankruptcy can have a massive impact on your scores, dropping it from 200 to 300 points. So if you had a 700 credit score before bankruptcy, it could fall to 400 after filing. Often when you apply for new credit, the lender will perform a hard inquiry on your credit. A lender performs this to check whether or not you're going to be a fit for their loan or product or credit card. And each time they do a hard inquiry, it could do, a few points, maybe 4 or 5 points. But if you've got multiple inquiries within a short period of time, that can negatively impact your score. Now, this one is going to sound counterintuitive, but even closing an account in good standing can negatively impact your score. You see, the length of credit history is really an important factor in your overall scores. And so instead of that 10-year history that you have, maybe you only have a shorter history now because you closed that one card. So when you close that account, you lose not only that line of credit, for your own use, but also the available credit that impacts your entire available credit, which again impacts your utilization. So if you had a card with a $5,000 limit that you close, you no longer have 5,000 available. It's going to take 5,000 away from your overall utilization numbers, which ultimately means it looks like you're using a larger percentage of credit, again, which can negatively impact your scores. And if you don't pay a bill or loan, the company might send your account to a collection agency. Having an account in collections can drop your score even by 100 points. A collection can stay on your credit for up to 7 years and just be a huge drag on your credit overall. So imagine this, you are starting to make some really good money, you're dreaming of buying a house. When you apply for financing, you find out that your credit score is actually 580. Ouch. This could be the moment that you realize you're not going to get that loan at all. But let's say you did get the loan, your loan is approved, but because you don't have a great credit score, you're going to be charged a lot more interest and at a higher rate. All of a sudden, you're paying thousands more, especially over a 30-year period for this loan, on top of how much the house costs. So if your score is under 680, here's exactly how to fix that as quickly as possible. One of the quickest ways to improve your score is by getting the debt off of credit cards and onto something like a personal loan. So what exactly is a personal loan? It's really just a loan from a bank or credit union. It could be an online or a brick and mortar institution. You then take the money from the loan and use it to pay off your credit cards. The great thing about a personal loan is that they usually have a much lower interest rate compared to credit cards. This means you'll pay less in interest over time, saving you a ton of cash. And one of the things that people don't think about is that there is a fixed time period which that loan will then be paid off. Unlike a credit card, if you're making the minimum payment, you can make the minimum payment for the next 30 years and not pay off the balance. Let's say you have $5,000 of credit card debt at a 25% interest rate. If you only make the minimum payment of $150 a month, it'll take you, in this example, 4 years to pay it off, and you'll end up paying $3,600 in interest. Now, if you take out a personal loan with a 10% interest rate and pay off the credit card debt, you could pay off the loan in 4 years at $127 a month, saving you $2,500 in interest. So this is one of the ways that I help my clients is instead of paying 30% on a credit card, we can cut that in half or better through a variety of methods, some of which we'll continue to detail below here. But ultimately, it is a massive game changer. So instead of paying, the minimum payment on a credit card that could take years and years and years to pay off, we shift the debt off of credit cards, your credit score goes up, and then you have a fixed monthly payment that we can just pay the minimum on for now until we get some other things sorted, like building the emergency fund, building savings buckets for Christmas and holidays and travel, vacations, home and auto maintenance, all the things, so that we don't get back into debt. I say all the time, debt is a symptom of a broken system. The two things we have to fix is boundaries around spending and then savings. We gotta build some savings. Taking the pressure off of the monthly credit card cycle enables us to find the cash flow needed to hit these other goals. So next up, we have personal lines of credit. Now, a personal line of credit is very similar to a credit card in that it allows you to get a certain available credit and you only pay interest on the amount you use. So just like a credit card, right? So let's say you have the following situation. You've got a credit card with a limit of $5,000, a balance of $4,000. So there you go, 80% utilization rate, which is gonna negatively impact your scores, obviously. And let's say you open a personal line of credit and you get a $10,000 limit on that personal line of credit. Now, the current amount used is $0. You haven't borrowed anything yet. But let's say you decide to transfer $3,000 from your credit card onto your personal line of credit. Now, the new credit card balance was $4,000. We take away $3,000. Now we've only got $1,000 on the credit card. Now the personal credit line has $3,000, which is the amount you borrowed from the credit card. So now that changes your new overall utilization. Your total credit limit of $5,000 from the credit card and $10,000 from the personal line of credit equals $15,000 of total available credit. In your balance, $1,000 on the credit card plus $3,000 on the credit line is $4,000. So we basically divide the $4,000 that's owed by the $15,000 of total credit, and we get a total utilization rate of 26.67% instead of the 80% before we started all this. So if your total credit utilization rate is high, one of the fastest ways to improve your scores is to move debt off credit cards and onto things like personal loans or personal lines of credit. Now, a home equity line of credit, or HELOC, is just another flavor of line of credit and can be a smart move if you own your own home. This type of loan uses the equity in your house as collateral for the loan. And the equity in your home is the difference between what your house is worth and what you actually owe on the home. So if your home is valued at $300,000 and you have a mortgage of $200,000, then you have $100,000 of equity. And a HELOC comes with lower interest rates compared to credit cards, which can save you money and help you pay off your debt much faster. However, it's important to just note that the home equity line is secured by your home. So if you can't make the payments, you risk losing your home. So be careful with something like this. So if you get approved for a HELOC, and let's say you pull out $5,000 to pay off some debt at a 9% interest rate, you could save a significant amount compared to a credit card with, say, a 20% interest rate. 9% versus 20%. Do you see the difference that can make? Let alone that with a HELOC, it's stretching the payment out over maybe 15, 20 years compared to the credit card. Lastly, let's talk about 401k loans. Some retirement plans, whether it's 401k, 403b, thrift savings plans for all you military folks and government workers, these can allow you to borrow from your retirement savings. This means you're taking a loan against your own retirement. The interest rates are typically more favorable and there's no credit check needed, and you're essentially paying yourself back instead of a lender. However, there are risks involved. If you can't repay the loan, it can negatively impact your retirement savings. Plus, if you leave your job unexpectedly while you're paying this loan, you might not be able to pay it all back. Or it could be considered a withdrawal, which means you'll have to pay taxes and penalties. So definitely weigh the pros and cons carefully. But for example, if you have a 401k with $20,000 in it, and you take a loan for $5,000 at a 9% interest rate, you'll pay yourself back with interest. It's typically going to be on a 5-year note. However, if you leave your job and cannot pay it back, you could face taxes and a 10% penalty on the $5,000, which is an additional $1,500. Who wants to pay the government more money? Not me. But if you go this route, 9% interest versus the 25% on the credit card is a clear advantage and can potentially save you thousands. So to recap, if you want to fix a bad credit score ASAP, consider personal loans, personal lines of credit, home equity lines of credit, or 401k loans to take the money off of your credit cards and fix that utilization rate. Now, everyone's situation is a little different, and I use most of these for my clients also, but everyone's situation dictates which one might be preferable. And here is the secret credit hack that I employ with all my clients that I mentioned at the beginning of this video, is that instead of getting to 30% utilization, we want to get down to 10%. So once we pay all our credit cards, we then pay our bills with our credit cards on autopilot only at a max of 10% utilization. So as an example, if you've got a $1,000 limit, we only want to put $100 or less on that specific credit card so that it pays itself off. My clients just put their credit cards in a safe or a sock drawer so they're not tempted to spend on them, and then let the credit cards pay themselves off each and every month. By being under that 10% rate, you're even more optimal, and you don't have to worry about when the statement period ends and trying to make sure that the credit card company doesn't take a snapshot of your credit while your utilization is above that 10%. So you're able to fly under the radar in a very optimal way, set it and forget it, and over time, my client's credit score shoots to the moon. Now, I know how daunting all of this can feel if this is not your area of expertise, but it doesn't have to be that hard. And it can be a breeze if you use my automation method. If you automate the process of paying off debt, you don't have to worry about late payments ever again, or micromanaging a budget, or trying to find the right app to track your finances. If you're interested in learning more, you can check out the video up here on how you can fully automate your finances. You can see we moved a couple weeks ago and I have still not fully unpacked, nor have I fully set up the background. So forgive me for that, but I wanted to jump in and talk about credit today. Thanks for watching.